Welcome, everyone. Welcome to our sort of special edition of Underwriting for Racial Justice working group today. As you know, we're going to be talking about how AI has helped us reimagine underwriting, and this is all part of the Underwriting for Racial Justice program. I'm Erin Kilmer-Neal. I'm Executive Director at Beneficial State Foundation. We launched the Underwriting for Racial Justice program. I guess we conceived of it back in 2019. In 2021, we launched the URGE Working Group, which is a cross-sector conversation that I'm sure many of you on the call have participated in, where we're talking about how can we reimagine underwriting to get capital to communities of color. And then in 2023, we built on that to launch a 2-year pilot program with, I think we have 18 lenders at this point, 18 lenders who have been working together over these 2 years as part of a cohort where we're meeting almost every month, talking about how can we unlearn things that we've done in the past, relearn, and test new underwriting approaches with each of those lenders with a commitment to thinking about how they can change underwriting and practicing how they can change underwriting to increase capital to their priority community, their community of color that they particularly want to get more capital to. And we've been doing that in partnership with Stratify, who has helped our lenders gather their data, analyze their data, understand their data, and get a sense of what can they change, and then actually implement those changes and test them out. So with that, that's a little bit about who we are, why we're here, what we're doing. But the stars of our show are the other people on the screen today. I'm going to ask them to each introduce themselves, and then we will kick off the conversation. So we have two of the lenders, and we have someone from Stratify. So Denise, I'm going to have you kick off, and then you can hand it to Spike.
Absolutely. Thank you, Erin. Hi, everybody. I'm Denise Johnson, CEO of Stratify. And as Erin mentioned, we are the sole technology provider of the Underwriting for Racial Justice program. What we do is we have a decisioning tool that helps you maximize the data you already have to create better risk strategies, automated decisions, and our proprietary technology is transparent, allowing you to see exactly how each decision was made so you can confidently expand access to credit without increasing your organization's risk. And we have used this technology to boost efficiency in many use cases, including lending, compliance, and fraud detection. And we will be focusing on credit decisioning today. With that, I will turn it over to Spike.
Thanks, Denise. Yeah, I'm Spike Hosh. I'm the Executive Director of BetterFi. We're a community development financial institution, CDFI, operating in Tennessee. And we're part of the URGE project and group, working with Stratify to improve our lending. Our main project is to create an alternative to and route out of dependence on predatory loans. So almost exclusively consumer lending, refinancing payday title flex loans, doing a little bit of microenterprise and credit building as well. Turn it on over to TT.
Thank you. My name is TT Killer. I'm Chief Program Officer and Acting Chief Lending Officer at Working Solutions. We are based in San Francisco, California, and serve the entire state of California. We're a micro lender that supports small businesses. Our range of dollars is for small businesses from $5,000 to $100,000. And we have also been a participant in the working group Underwriting for Racial Justice, and so also supported by Stratify to our project. Really, a core need for us was expanding our decisioning to be able to do things faster. And so we'll talk more about that today.
Thank you all. So these three are some of the rock stars of the program, and I'm really excited to share what they've learned and what they've done in their organizations. Before we jump in, I just want to let everyone know we are in webinar mode, which means you have a Q&A button at the bottom. Please feel free to use the Q&A button. We'll be monitoring that more so than chat. So definitely do use that. The webinar is being recorded. And I think with that, I'm going to go ahead and move us back over to Denise to just tell us a little bit about your experience in the program so far.
Absolutely. As I mentioned, so I'm hoping everybody can hear me well. What we started as a part of the technology, being a technology provider to this very important program, is that we worked with, as Erin has mentioned, as we worked with all the participants in multiple ways. We have some of them were focusing on, how do we make our underwriting more efficient so that we can process more loans, serve our communities. How can we be more efficient? Others were interested to learn the primary blockers to expanding the credit box. So, there are already a number of the CDFIs and lenders already have flexible underwriting. So they were looking at, it's taking us very long. Can we do things? Can we look at our, what is blocking us from moving faster to serve our communities? There were others that wanted to understand the right underwriting metrics, understand if they were good borrowers among the decline applicants, of the looking at the historical data. Are there more applicants in lower credit scores tiers that they can be saying yes to? And then some of them wanted us to look at the policy changes that they might want to do. And others wanted to know how important FICO is predicting borrowers' performance. And then we also had the unique, work that we did with one of the lenders on the impact of technical assistance on the borrower performance. If, when it's more effective, is it before or during the application process or post-loan closing? So we went through quite a few analysis. But as a part of this, we also, I believe, gave an understanding to how you should think about your data. Because one of the things that has been really heard is that usually when you think about AI or machine learning, the advanced technologies, when you're a smaller institution, you might think that that's, out of your league, if I might say so. But it is actually, this program proved that that is not the case because of the number of successes. So I'm going to stop there and actually pass it to TT because the actual success stories, we can tell you what we did, but we want to hear from the success stories. So TT, as one of the participants, what were your objectives in participating in this program?
Yeah, thank you. So I would first say, this is it's a great opportunity to have been part of it and to continue to be a part of it. I'm representing many voices on our team because we had, different team members that stepped in to do so many work and support this kind of, engagement. And just grateful that the Beneficial State Foundation even just kind of opened this up for CDFIs and for organizations. So first is that, to kind of give you a background, working institutions, we're a micro lender. And what that means is that we prioritize small dollars deployment in communities, and those are the $10,000, $15,000, $20,000. We do up to $100,000, but the small dollars matter because they are the stepping stones that help businesses get up to that next level. But also it's expensive. it's expensive. This takes the same amount of time and costs the resources to get that small dollar out that it is for 500,000, $200,000. And so you find a lot of small lenders that do not want to participate there because there's not enough like economies of scale to be able to get to that, to make it sustainable. And so over time, we have the tension of both, like we have impact as like our top, like, North Star, that we do deploy capital to communities of colors. We deploy capital to women. There's an intersection, of women, of low income entrepreneurs, of entrepreneurs of color, that are a majority of our deployment, and over 80% of our deployment goes to the intersection of all those kind of groups. And so we know that there is a need on the racial line is a constant need that we know that we have committed to serving. But on the other end, we also know that to do this at scale, we're now moving, at the point where we're joining, we're moving statewide. We want to continue to do this at a higher volume. Well, we're going to have to kind of take some learnings and find other tools that would help us to continue to do this, and to do this work in a way that is more efficient. That we can kind of reduce time on the work that we do, and that we also can continue to serve the people that we've committed to serving, the most vulnerable in the population that we've committed to serving, that we've been serving well, but we need to do it bigger. Now, we went from like 9 counties to maybe about, half the state. And at the time we're joining, we're moving to like statewide. And so those were the tensions that we were facing coming into the space. And those are part of what kind of, where our objective was: how do we reduce time? How do we serve the communities that we've committed to serving well, continue to serve them well, and also not increase risk at the higher pace.
Wonderful. Thank you, Titi. Spike, how about you? What were your objectives as you approached, as you started as a part of the Underwriting for Racial Justice program?
Yeah, it's good to hear from Casey, because I think a lot of these problems are the same things that different community lenders focus and face, right? Because wherever you go, whether it's California or Tennessee, there are predatory lenders that will try to target these populations in our communities. And so what we're all trying to figure out is, how do we do it fairly, equitably? How do we do it and not lose money? And how do we address the need for like these smaller loans, right? So BetterFi specifically competes against what I would call predatory lenders, payday lenders, title lenders, flex lenders, right? And what they'll say is that, we have to charge a triple-digit APR in order to serve these communities because of the cost of origination. It's expensive to these loans because of the time that takes, because of the default rate, because of the charge-off rate. And basically what they're saying is that these vulnerable communities are conventionally risky and a bad bet. And the only way you can do it is, if you're in Tennessee, you charge 280 to 460% APR. Or if you're a tribal lender, you can charge up to 1600% APR or whatever it is. So us, BetterFi, as an entity trying to create an alternative to that, are trying to achieve the same things that sounds like Working Solutions is trying to achieve. We need to get dollars out quicker. We need to do it safely. We need to lower our delinquency and default rate. But what it comes down to is, if we want to provide, our average loan size is $2,000. If we want to provide $2,000 loans, and we want to compete against the people charging 300%, we've got to be better at it than they are across the board, basically. And so coming into it, those are really our objectives, right? Same kind of thing. Lower cost of origination, lower default rate. But as we got involved in Underwriting for Racial Justice, that actually coincided with an expansion of ours. So we were moving into Chattanooga out of rural Grundy County, and it's a more diverse community. And also it's a community with a lot more predatory lenders. The predatory lenders are more likely to target, economically disadvantaged groups in Chattanooga and across the state. And so we knew we need to make sure we extend credit to those same people who are being targeted by predatory lenders. Our objectives kind of evolved as we talked with Stratify and Beneficial State, because we realized that by working with Stratify, we could also evaluate on the back end, are we meeting the right need? Are our loans reflecting the community? Are they reflecting the populations that are targeted by predatory lenders? And so that let us do it, in a really kind of proactive and intentional way as we expanded into a broader community and into the state writ large.
I think I'm going to jump in. What were the changes that was implemented? We have both of you have started with what your objectives were, what were the pain that you were facing with. So how was the experience? What changes did you implement, and what was the impact of the changes, and what was the process like for you? And I'm gonna, I think this is for TT.
Sure. Thank you. And so with the support of Stratify team, the technology aspect became one that we needed support with in terms of data. So one of the support they extended to us was we provided a significant number of data points to them to help analyze our track record around what were the factors or what are some indicators that showed in terms of like order of priority and strength that we could lean in on to make a faster decision. And so, and to our surprise, one of the top ones that it came back to us was around the number of years in industry. And we've always thought it was like debt service coverage ratio. That was not the highest rated. It was, no, it was the years in service, and it was about 6 years. And the credit score was like the next group. And there's some other ones that they had so many sophisticated like mapping and, different kind of scale points that they gave us. But we were able to take those indicators and they gave us some kind of metric and say, if you lean in on this and based on this credit score, this will be the impact on your demographics. If you moved it higher on the demographic, maybe move it from 630 to like 700, you're going to lose a significant group of like the communities of color. And so they showed us like, based on our decisions, some of the shifts that could happen if we were to kind of maybe move it too far higher. And so we were able to kind of take the data points. So first is we giving them the data, they using that to analyze the work. And that was a process because luckily we've been an organization that's been very much a learning organization and also a very data like centric kind of group where everything gets like recorded. We have data points for everything, and almost like it's ingrained into like the work culture that we track a lot of things. And sometimes we even like clinging onto data. It's like, should we remove this field? Should we take this field out? And we're like, let's get rid of it. It's been like 10 years since we used this field. So that's the kind of organization. I'll give that credit to our, director of data impact, Natalia, that's done a fabulous job in just keeping us going on that workflow. But that kind of, because we had that readily available and she had to do a lot of cleanup work, we're able to provide that data point, and that helped the Stratify team to do some strong analysis and come back to us back and forth with some feedback. And then we'll give them some pushback around, can you check this data point? And so there were some conversations around it. And then we had meetings with the team, with first our direct executive team. We are meeting with our lending team and our portfolio servicing team as well. And so those engagement, there was some level of like kind of conversation that also allowed us to have other team members involved in the workflow. And then from there, our lending team, myself and director of lending, took those data points and went to work with creating what I would call a faster kind of what we call an express review product. Right now, it's the same terms. Nothing has changed in terms of terms and what we're offering, but it's that we can expedite some review based on the data points that we now have. And so we created a new express review that allowed us to say, okay, first, if you have industry experience, and this is industry experience, this is not business start date. So you could be a startup and we can still use this metric for them. And then we also use as a credit score. They have a minimum of 630 scored. On a regular day, we don't have a credit score limit, but this is just try to see how can we get to a faster yes on our loan. And then the next group was to be able to say, how do we move our loans from from moving it, to, the quality. And so we then added some additional level from not just the credit score. We want to see revolving credit because those are data points that we have access to. So we added a few other kind of factors inside of it to be able to kind of identify, certain risk factors. And believe it or not, we rolled that out. We did a test pilot in April. And just for a small dollar, up to $25,000, we were able to start seeing that we could make a decision within 2 days versus 2 weeks, 2 days, or even like 2 hours, if I were to be very specific. Because if it turns to somebody, they review it, and it turns out to the next decision making, we can make a decision pretty quickly. And so the next level was to say, okay, how do we move this to a higher dollar amount, not just limited it to 25,000? And by July, we rolled out to be able to do that across board. We also added a tool that allowed us to be able to, because the other key was how do we get information about their capacity so that we don't wait on their P&L and their bank statement. We're able to connect to some of you might know platforms like aggregate bank financial data like Plaid and Decision Logic. We utilize Decision Logic, and that allows with speed to be able to quickly access their financials up to a year's worth of financial data, run an analysis on if they have the capacity, then already overlay the Stratify kind of insight that they've given to us, package that together and get a decision out. And so far it's been working great, and we've seen from like about 48 days to about 15 days of like just document collection, and decision is like 2 days, less. So it's a complete turnaround for us. We still have applications that goes through the manual process for different reasons, but to be able to to support our clients and to get to faster yes has been a game changer for us.
Very similar at Betterfy, I think. Yeah. So, our process kind of going into this was very manual. It was based on kind of iterations of credit committees looking at different loans and oftentimes adding different types of information that they wanted. So, I think in 2018, we started with 10 loans on a spreadsheet. And basically the information we included was like, do they have a job and how much are they paying on the predatory loan? And then over time, various credit committee members would request additional information about like how long have they had the bank account, how long the job, how long have they lived somewhere. And so we kind of had this unwieldy amount of information that we were taking in. And so in working with Stratify, we were able to basically create a fast track system. It sounds like Working Solutions did. So we had some hunches about, what kind of metrics, what kind of information do we think is likely to tie to performance data, but we had no idea if it was a good hunch, how it bore out in the data, and whether or not it was accurate. And so like one of the things we were looking at is our own kind of in-house DTI calculation that takes into account certain things that a bank might not. And then also a discretionary income calculation that basically takes their income, less debt expenses, less a subset of essential expenses. And so we knew that obviously a DTI needs to be lower and discretionary income should be higher in order to have a loan perform, but we had no idea what those amounts were or where they should be. And so, we know that going into this, we're always going to take longer than a predatory lender. If someone walks into a title loan place, they're getting a 264% APR loan, they probably can walk out with cash, in an hour. And so for us, we're never going to get to that level, but the shorter we can make it, the quicker we can decision, and the better data we can use to make those decisions really improves our entire process and helps us, build rapport with our clients, their applicants, and have them be successful borrowers on the back end too. And so with Stratify, they basically crunched our data, all the analysis of, the information we were collecting about, where they lived and what type of, if they rented or owned, if they had the bank account for 6 months or 4 years, and they turned over to us essentially 2 easy to follow kind of deterministic rules. So if DTI is below this amount, and if discretionary income is above this amount, these loans perform way better than the ones that don't meet that. And so since then, we've essentially in our process added a flagging system so that every loan that meets that gets flagged, and we know this meets the Stratify criteria. And so we know it's much more likely to perform. And so that's enabled us to more quickly approve loans, get money at the door, also help our clients stop paying these APR and interest fee rates they're paying at payday lenders, and then kind of side effect of that is that we have now also instituted kind of a lending authority limit. So the staff can approve up to a certain amount based on the average loan size, and really using those stratify guidelines as kind of the determining factor if everything else checks out. And say a fast track us up a ton, we're getting more loans out, and it's came in a great time too, because as we expanded in Chattanooga, we had, far more applications, far more people starting applications, inquiring, and things like that.
Wonderful. I'm doing the transitions, but I'll ask a couple of things more. Spike, uh, what has been have you heard, what has been the feedback from your customers with the new lending experience? And then TT, uh, similar question coming to you after that.
Yeah. I think just the quicker we can turn around decisions improves across the board. I'll say another side effect of this whole process is by making clear to ourselves what is likely to be a good loan. We were able to articulate that to our applicants too. And so part of our whole process is to be as transparent as possible. As soon as someone comes, we try to immediately understand, do they have income? Are they in a predatory loan? And just quickly say like, okay, does this look like it might work? Is it a type of thing we can work with? And then as we collect the information from them, as they go through the application, we can also inform them, this is kind of what we're looking for based on our data analysis, really stratifies. This is what we think makes someone able to pay a loan back. And so whether it's in the application or the loan or in TA, when we're doing budgeting or coaching, we're able to use those guidelines to make clear to our applicants and clients, whether or not they can afford something. But I think one of the things we try to prioritize from the outset is never extending credit where it's not really going to help someone or solve the problem or worsen the problem. And so these kind of guidelines help us articulate that and kind of inform our applicants, clients, partners, referral partners about what we're looking for and why. So I'd say it's been good. And just, the stories we have from our clients are pretty telling. One of our first applicants in Chattanooga, she was an older woman, we call her Jody, that's not her name. She was living on, I think she was on Social Security and she had a pension. She was bringing in maybe $1,400 a month. And she had taken out $2,000 in predatory loans for Christmas presents at places right down the street from our existing Chattanooga client, our office. And so she borrowed $2,000. She was paying $400 to $500 a month for over a year and a half. And so, what was her option if we weren't there? She was going to be stuck in this thing. She owed more than she borrowed, and she had paid $7,500 on it. And so when she came, we were able to look at, she had good credit, if a thin credit file. She had income. Her expenses were pretty low. They met the stratify kind of conditions. And so we were able to quickly approve that. In 12 months, she paid us back and paid off the loan. So compared to $7,500 in interest and fees at the predatory lenders, she paid us about $250, was out of it, was able to build her credit, and now hopefully can, graduate to conventional finance if she needs something else later.
TT, anything that you would like to add from your experience?
Yeah, I love Spike's story. I think anytime you're able to save clients money and save them time, it's a win. And predatory lenders are so much faster. They tend to be faster than us as in the space, and so that tends to be an area where we can kind of have gains. We're able to set the clients on the right path faster. I would say this is a new rollout for us, and we're seeing one thing is like the internal wins have been great because we're able to make decisions faster, we're able to review faster, and it makes it easier for our team with the more we have those applications. But also, we're seeing some positive loops also from our partners because we get referrals from different partners, from bankers, from or different SPDC centers that support small businesses. And when we share with them, we have this new express review. It's always exciting to be able to kind of hear what the opportunities are. And so I think, being able to turn around and get the decision out has been a very an amazing, well received with with our clients. Most of our clients, because the terms remain the same, but particularly a few clients that we've served, they've all been very excited. I'll say surprised that they were able to get the funds so quickly. Because the turnaround that they've been used to before, we were able to kind of just turn around and said, nope, it's already approved. Turn this document in, and with less documentation. And so they're saying they're excited about this, and even sending referrals back to us for it. So
Thank you both. I can jump in and just say, first of all, it's so exciting, all of it, like to hear the scale that you're able to achieve, the speed that you're able to achieve, and then actually like hear the stories of how people are impacted on the ground. It's very heartwarming as what we wanted to see coming into this program, and it's really very cool to see. I did see that there's a question. This was for Spike. From Anna or Anna, what does your DTI calculation include that a bank calculation doesn't, that you mentioned earlier?
Yeah, I think the main difference is that we add debt expenses that a bank might not notice from credit reporting. And then also we include things like rent. So we're trying to look at housing expense plus, minimum payments on things like credit cards, things like that. The other big place where we differ, I think, is that we also calculate what they're actually paying, even if they should be paying more, which I think is not always the case. So almost all of our clients come in either not having had credit, and so they had to turn to predatory loans, or they could have accessed conventional credit but exhausted those options. And in cases like that, we'll work sometimes with like a credit counseling agency that can help settle credit card company loans, things that are in default and collections. And so we try to look at what they're actually paying to make a decision on if they're able to pay us back. Sometimes they've let cards go bad, they're in collections, maybe they're about to be charged off. And so, of course, we try to assess if that's likely to result in a garnishment or something, but we're not looking at really what they should be paying, but what they are paying, and using that as a determining factor. I think that's the main difference, and then adding rent in there.
Yeah, that's a really helpful articulation. And do you find any additional income in that process as well, ever?
We do, yes. Yeah, so we'll count money that may not really be income if like a family member is helping them every month, if they can kind of show it to us and document it via plat or a bank statement or Venmo, stuff like that. And so really, I guess the best way to kind of frame it is we look at like a cash flow. So we're like, what's the money coming in? What's the money going out? Can we help you save money by refinancing some piece? On the flip side, if someone comes to us with a title loan they never pay on, then when we do our calculation, we're adding that and saying, does this make sense? And more likely than not, it doesn't make sense then.
Right. And I see you nodding your head, TT. So, and you said I forget the platform you're using, but also cash flow. Are you finding some interesting data in there that's helpful as well?
yeah, because it's also aggregated over a long period of time. We use a decision logic, and so we can see all their bank activity, and we also take a look at look at all sources of income coming in. And sometimes you might see, oh, there's this deposit coming from somebody. Who is that? It's like, oh, that's my mom. Okay, so if she's a contributor, we can probably include that if we have something that we can show, or maybe that person comes in as a co-signer to support it, to help. So we're trying to get to yes, but get like the informal income sources that they might undermine. And so we want to kind of see if that's something that's that we can count on, that's consistent, then we would include that in our review and cash flow.
Yeah, that's great. And I see another question that came in, so I'm going to go ahead and ask that one. It says, the time savings resulted in each organization being able to process more loans. If so, how much more capital have you deployed? How many more or like money deployed or number of loans processed compared to previous periods? I don't know, Spike, do you want to start?
Sure, yeah. It's a little hard, I guess, to know what the exact impact was because we were expanding at the same time. But just for comparison's sake, I mean, coming into this year, we were lending not very much. We had one small office in a very rural Tennessee county, in Grundy County. And I think we were, lending. Last year we lent 150,000. This year I think we've lent, we're nearing 400,000. And so, I mean, we're doing a lot more. But it's partially because we're doing it quicker. It's partially because of the Stratify stuff. It's partially because we opened this new office in April in a more densely populated area. But we would probably be in trouble without the fast track option for a lot of these loans. Because whereas like before we opened the Chattanooga office, we'd have maybe, 5 to 10 applications a month. Now we're probably seeing 40 to 50. And so being able to parse a lot of those is helping a ton.
Yeah, that makes sense. What about you, TT?
Yeah, I would say we've seen definitely an increase in the ability to serve more, but but also again we're also kind of at that intersection of like some other volume coming in because of some of expansion, staff kind of growth, and so we've gone from about 100 applications being processed, about 150, 170, and with no additional staff. And yes, we have an overflow mechanism to support some of that work, but what we're trying to do is to also find a percentage kind of continuous balance around what's express review and what's a manual review. That's where we are now, and that would require continuous, like just our marketing efforts to let people know that hey, we can potentially support you, especially with maybe banks tightening up and certain businesses that maybe they thought they couldn't, that this would not, that we could be a support for them to kind of meet that need and do it fast for them. So
Yeah, and I appreciate that point. That's one thing that I was thinking about too is what excites me about the fast yes is the ability to have this overflow to spend time with the other folks, right? So rather than doing a fast no and only serving the people who are kind of cream of the crop, you do the fast yes, and then you can not only deploy that time savings to increase the number of loans, but deploy that time savings to support those other folks that you might need to spend a little bit more time with. And you just spoke to that, but I don't know if either of you want to speak to that any further, any experience around that.
that's the philosophy again, yeah, because we are still high touch. We still have questions. Clients still call us if there's a decline. We still have get on the phone and explain what they can do to make things better. Those take time, and so being able to continue to do that, and also kind of create the equilibrium that we need across like what we need as an organization in terms of like the loans that production that's necessary, but having the time to serve our clients because there's the reason why we're here is to support the vulnerable communities, and so just being able to do that now, giving more time to do that is what we're excited about. So
It's definitely freed up some time for us in terms of we have in the last few months started kind of doing a higher touch TA track for denials. So if someone comes in, especially if they have a new job or if they have a predatory loan that's new and we might not approve them otherwise, we can spend like either a couple months, we do a piece of it, we see how they perform on that, and we set some kind of technical assistance criteria like, all right, we're going to get together and create a budget and see how you can work with it, or you're going to meet with our credit counseling partners to do intensive budgeting or address this other piece of debt that we can't help with. And so that lets us get to yes, even if it's a few steps removed. Yeah.
Mm-hmm. Yeah. Yeah. And I think what both of you are sharing is that it sort of dispels a myth or the tension that you can't scale and also be hands-on, like myth 1 and myth 2, that AI takes the human out of the equation, right? Like I think what you guys are doing is both. You're using the best of both worlds and still ensuring that you are being humans, using human thinking, using support, being there, as you said, to vulnerable communities while using the AI just to help you along the process. Denise, I saw you were going off mute. Go ahead.
And the third thing probably is the fact that you're never too small to utilize these types of technologies to be able to serve more communities. So that's I would say that would be the third thing. But I want to ask you a question, Erin. So we are talking about the amazing impact that Spike and TT saw as a part of this program. Is this program only for CDFIs? I know the
Yeah.
answer, but
No. So the 18 lenders that we had, I always like to say that we have 18 folks and it's an N of one. Like everyone is different. So we have banks, we have credit unions, we have rural CDFIs, we have urban CDFIs, we have native CDFIs, we have national CDFIs. So and the banks are ranging in size and geography as well. So this cohort was quite varied. And we are planning on doing a next cohort, and that will include and probably focus primarily on banks as well. So we want to continue to make sure that we're helping everyone in lending to figure out how to use these tools and to increase capital to whatever their priority community of color is. So stay tuned on that. And I see another question came in from Lisa Smith. How are you working with your other entrepreneur support organizations, SBDCs, et cetera, as TA providers for referrals to your programs, as well as support folks you're trying to serve? TT, you want to start?
Sure. We are actually launching what we call the Train the Trainers to bring some more transparency around our underwriting with these changes that we're making, so they can kind of see like the different tracks that an applicant can go through, and they can also understand some timeline dynamics that impact. And one of the things also we start tracking is factors that impact underwriting speed. For example, if somebody has multiple businesses, that would increase time spent on it. If somebody has, they're asking for debt refinance, if they are doing some more like high projects, like very project intensive, time intensive projects, so that they have more clarity and they can provide the back end supports and help reset expectation for the client. But then there are some applications that can go with fast speed, and so they just understand what are the things, and then also become a partner in helping us reduce those time barriers over time for the communities that we're serving.
With respect to like micro enterprise and entrepreneur stuff, we are just now starting to do that. So that's all TBD, I think. But we work with a lot of different partners on the consumer lending piece. And so really, like, for example, even though our offices are in Chattanooga and Grundy County, we've been working with like the Upper East Tennessee Human Resources Agency, with United Ways across the state. And so really, this just helps us to articulate what we're looking for, what kind of people we can help, what situations they're in. But also it helps us be pretty flexible. Like we have a church in Chattanooga we're working with that was getting cars donated, and they had their own faith and fitness class. But they're like, some of the people in this class need these cars that are donated. So we've been able to help them basically create a program where we service 0% interest car loans for them, for people in that program, to kind of leverage off of what we're learning, the work we've done to analyze our own loans, what we've learned from processing our own loans, underwriting, due diligence, that kind of thing.
Both of those are really great examples. Yeah. And Lisa agrees. So in cases where we refinance predators, it often feels like we're bailing them out. For merchant advances, they take the fee up front. Do the predatory lenders ever settle for less than principal given the receivable quality?
That's on the merchant cash advance question. That's something we're trying to figure out with our new business lending. If there's a version of what we're doing with consumer loans that we can do with business loans. I'll say with like the consumer predatory lenders, they never settle for less than principal. Even, all the credit counseling organizations that will negotiate and try and settle on behalf of people like nearby us, the easy, quick cash places are happy not to settle. They, usually make enough interest and fees that they've covered the principal amount after 2 or 3 months, maybe. And so everything else is gravy to them. So it is kind of bailing them out. And it's interesting you say that. A lot of our social partners like that help with like light bills or housing and rent, a lot of times they don't want to help someone with a payday lender because they're going to pay off the payday loan. So that's where we can come in. We can refinance it as an affordable installment loan to get that person out. And so we are bailing them out to an extent, but they are paying us back. And our rate is not necessarily cheap. It's like a credit card rate. And we're a 501c3, but we still see relatively high charge-offs. We have a cost of capital. And so people are paying it back, but at least they have an avenue to actually pay it back, actually build their credit and get out of the situation they're in. But what you're talking about is also part of us figuring out the underwriting, right? If someone comes to us and it looks like they're taking out every loan they have access to and not paying on it, that's going to be a problem versus someone who had a car repaired, couldn't access a loan to fix it, didn't want to lose their job and then lose their house. So they did the one thing they could, which was go to a flex lender and borrow at 280%. And maybe they've been paying on it, doesn't show up on their credit score. And so they've usually probably paid more than they borrowed already many times over. And so we bail them out, but they are paying us back and get out of it actually.
Yeah, super, super interesting question. Gets my mind turning on how can we make it less helpful to the payday lenders, but I love how thoughtful you all are being, Spike. So I know we had a question that I wanted to ask you both, hopefully on behalf of the other folks in the room who are probably wondering this, which is like, how, what were the difficulties and, the ways you got over any barriers that you had internally to do this work, whether it's on the data collection side. I know TT, you said that's already part of your culture and you're both already mission organizations, but did you encounter barriers to whether it's time, money, perspective from leadership to doing this work? And yeah, TT, since you're off mute, I'll see if you want to go first.
Sure. I would say I think we've been hungry for a change and for across our organization because there has been bottlenecks that we've had to navigate around processes, and we've been fixing them and fixing them. So I think while there's been eagerness for change, there's also been fatigue of change. And so it's balancing that out and say, okay, what's one more thing? It's kind of like, I mean, I've never moved that much in my life, but assuming like you're moving every like 2-3 months and then you've got like 5 kids and you've got to move them and you're going to like get them excited. There's another move and there's another move. And it's like, okay, we enjoy this like new location, but it's really stressful. And so I think that was the part that we had to navigate of like, keep the excitement of where we're going, but like acknowledge that it's going to be a challenging process and then try to find ways for say, okay, we'll take this off your plate because we know this is going to happen. But just like trust us that there's growing pains, and so like getting the buy-in of like, and acknowledging that there's some growing pains that we all have to navigate. Leadership was supportive. We didn't have any like counter on that. And then we also had to kind of work around, it's not just like one team kind of designing like the shift that we're making. We had to work with our data team. We had to work with, our portfolio team. We had to get everybody kind of involved to understand, okay, where we're headed and to make sure that we don't have an unintended consequence that people kind of feel like they were not included at the beginning. So that, I think that was the biggest challenge. And then the design process and then the initial rollout pilot process, being able to kind of tell clients, that we're sorry, there was some blip in this and some like invisible, like tracking that we didn't realize that was invisible, that you fell off the map. And then we had to find you again. So all that pain points, I think being able to have team, just the key is acknowledge that there will be breaking points, but we're solving through it. And now we see the light at the end of the tunnel. It's exciting. People can appreciate it, looking backwards. And if there's another shift coming, it's like, we've done it before, we can do it again. So.
Yeah, that was a lot in there. I really appreciate that. You had, first of all, there's motivation because you're trying to solve a pain point that you already had. Then I heard the sort of just change management principles in general, like making sure you're aware that it's not going to be comfortable. You're going to hit bumps in the road and you're just kind of talking through it and helping the team through it and involving everyone on your team so that it's not just a project of one team. And then, yeah, so those are, I think you said even more than that, but those are 3 really great ones that I pulled out. So thank you. What about you, Spike? Yeah, thanks.
Yeah, I'll say, unfortunately, the best thing for data is to have been doing it all along, right? And so
Right.
how to go back in time and do it is better. But we definitely have learned some stuff about like data collection and how to collect data that can be accurately put in by applicants. Like, for example, early on, we would ask applicants how many months they lived at their current address. And that's just like almost a useless metric because sometimes people put 1 and they meant 1 year. Sometimes people put like I don't know how long, 3 months, 8 months, whatever. And so simplifying it into like buckets help a lot. So 0 6 months, 6 months to a year, more than a year, whatever. So that definitely helped. We've been lucky enough to have a very supportive board. I think from the outset, we know that we're competing with people who turn loans around quickly and charge a lot and really actually build up pretty good rapport with their applicants. So we need to figure out how to do some of those things ourselves. So the board's been supportive, willing to try things out. It helps that we're hyper small. I will say there's a bit of a hurdle with board members who came from conventional finance, right? Because whenever we have like a new credit committee member who spent their career in consumer finance or mortgages, the first time they see kind of the makeup of our applicants, they think, why would you give a loan to this person? And so helping and underwriting for racial justice helped us a lot with kind of the information that y'all have shared, helping them understand the framing of the problem, that, conventional risk metrics might leave out all sorts of unrisky borrowers has been really helpful. And over time, the more success we have, the better, the easier that gets, right? So I think we're coming a long way, but having people on board from the outset, understanding we need to try things, see what works, test things out, be open to kind of abnormal or unconventional underwriting processes really makes it a lot easier.
Yeah, that's great. I'm glad to know that, that data really can be helpful and those stories really can be helpful in understanding the reframing. Denise, did you want to jump in?
Since we talked about data, I have to jump in. I think that one of the things that we saw working with very varied participants, we had very small, large, and different products, across the board. One of the things that was really that came out of this program was that everybody now understands that the power in their existing data, a recognition, instead of saying, "Oh, I have too little data," or "I don't know where my data is, but I think it's here." Like, everybody as a part of this not only knows what data they need, but how to use that data to support their outcomes that they're looking for. I think that was a huge gain. In addition to all these tangible efficiency gains, speed to decision, greater access to capital, these are all very tangible, very actionable and measurable, but it is that understanding that how much insight your data carries and how you can use it with the right technology to meet your mission was, I think, the I'm not going to say unspoken because we're speaking about it, but it is the soft win that actually has incredible strategic advantage to all the lenders. And the next thing is going to be, how do you measure your customer stickiness based on this?
Yeah. Yeah, good call. Yeah, it's going to sets everybody else, everyone up for better future, right? So, I know we have 3 minutes left, so maybe we can do like 30-second closing thoughts from each of you. It could be words of wisdom or advice or whatever, something that changed for you personally in your thinking, whatever you feel like leaving folks with. And I'll go in the order of my screen. Spike, TT, Denise.
Yeah, I don't have any words of wisdom, but I do think it's important just to be thinking about how the competitors that all of us have are going to be using these tools. I know that like the title lenders are going to be using these tools. So if we can leverage tools like this for the greater good, then it's really critical, and finding a way to do it is really important. So I'm very appreciative to, Beneficial State, URJ, Stratify for helping us figure out so much of this.
I love that. Using the tools for good. TT.
Yeah, I agree with technology, embrace it and like kind of be like have a learning mindset so you can understand what fits. And one way we do that, we sit it on demos just to understand what's happening out there and what could be helpful for us, even if we might not be ready for it, but we understand the possibilities of what we could use when the time comes. The more we can be ahead, like Spike said, of what they call the predatory competitors, the better we can be to serve the community. It's for the greater good overall. So, yeah.
Just be curious, right? I love that.
Thank you.
Denise. Yeah.
I'm going to answer Will's question as well as so we are a technology enabler. You know, think of you know what we have done is as a technology enabler, we allowed the lenders to keep your control, but also enhance your work and impact and ultimately drive the impact. And to do that, and I mentioned measurable benefits. We, at the beginning of the program, we did a baseline impact report, and then anytime we received a new set of data and new set of analysis as these changes were put into production, we had another impact report showing what has changed. So with that, it was very much about using technology as an enabler to make to serve your communities more in a faster and better. With that, I turn it over to Erin for the closing
All right. Well,
remarks.
thank you. Yeah, we're at 10 o'clock. Really appreciate everyone joining us today. Very much appreciate the three of you, all that you've done throughout the 2 years and sharing all your learnings today. We will be putting out a report. Urban Institute is doing a report on all of this. So speaking of impact, at the beginning of next year, you'll get to see the results of our 2-year program. We're going to be figuring out what 2.0 looks like. Some of the folks will be continuing on their 3rd year. We're going to extend. We have blog posts that we're putting out with our learnings on a regular cadence. So thanks again for joining, and hope all of you can be curious and use these tools for good. Thanks, everyone. Take care. Bye.